Warren Buffett calls The Intelligent Investor the best book on investing ever written. He read it at 19, said it changed his whole life. When I read it, something shifted for me too, because this book doesn't teach you how to predict the market. It won't hand you a secret formula to get rich by Friday. It teaches you to think about money, about risk, about staying calm when everyone else is losing their mind. Today, I'm breaking down the 5 biggest lessons from it, the ones that'll save you from painful mistakes and finally show you what investing intelligently actually looks like. Grab a coffee, let's get into it.
Welcome back to Money and Market. This channel breaks down investing in plain English. No jargon, no hype. Today, we're diving into Benjamin Graham's The Intelligent Investor, the book Warren Buffett has called his single biggest influence. 5 lessons, real examples, things you can actually use this week. No fluff, no filler. Let's start with the one most people get completely wrong.
Lesson 1. Meet Mr. Market. Imagine you own a small bakery, steady customers, decent profits, nothing flashy, but it works. Now imagine a strange neighbor shows up every single morning. Let's call him Mr. Market. Monday, he's ecstatic. I'll pay you $1 million for this bakery. Tuesday, he's devastated. Bakeries are dying. I'll give you 50 grand. Take it or leave it. Wednesday, he's back to loving bakeries again. Would you take this guy seriously? Of course not. You'd think he needs a nap. But here's the twist. In the stock market, we listen to Mr. Market every single day. Stocks rise, we feel like geniuses. Stocks fall, we panic and sell. Why? Because it's on a screen. It looks official. Graham's point is simple. Mr. Market is emotional, moody, often wrong. His job is to serve you with prices, not to tell you what to think.
So what's the smart move? Use his mood swings, don't get pulled into them. When Mr. Market panics and prices crash, that's not a warning, that's often an opportunity. When he's euphoric and everyone's throwing money at anything that moves, that's your cue to slow down. Look at 2020. Microsoft, Apple, Amazon all went on sale during the crash, not because they became bad businesses overnight, because Mr. Market was having a meltdown. The investors who understood this didn't panic, they bought. Your job was never to predict next week's price. Your job is to understand what you actually own and act only when the math makes sense. That's the whole game. Know the value, ignore the mood.
Here's how to actually use this. Next time the market drops and your feed is full of panic, pause. Don't react instantly. Ask one question. Has the actual business changed, or is this just Mr. Market having a bad day? If the company is still solid, still selling, still profitable, a price drop isn't a red flag. It might be a green light. Same logic in reverse. When a stock is soaring and everyone's celebrating, ask yourself if the excitement matches reality or if it's just mood again. Build a simple habit. Before buying or selling anything, write down the real reason, not the headline, not the group chat, the actual reason. If your reason is everyone's talking about it, that's not a reason. That's Mr. Market talking, not you.
Lesson 2. Stop speculating. Investing and speculating are not the same thing, not even close. Investing is buying a house you actually plan to live in. You check the roof, the plumbing, the neighborhood. You're building something real. Speculating is buying a house because a stranger online said prices are about to explode. You've never seen it. You don't know the street. You're just hoping someone pays more later. Graham's version of investing means 3 things. You do the research, you protect your capital, you expect a reasonable return, not a jackpot. Most people think they're investing. They're actually speculating, chasing hot tickers, buying because a video told them to, not because they understand the business behind the stock. Ask yourself something. Would you buy part of a random pizza shop you've never seen just because someone said it's about to blow up? No, but people do exactly that with stocks every single day. Remember the dot-com bubble? People threw money at anything ending in .com. Didn't matter if the company made 0 revenue. Didn't matter if it sold nothing at all. Prices soared. Then it all came crashing down. That wasn't investing. That was speculation dressed up as opportunity. Graham's golden rule: treat a stock like part ownership in a real business, because that's literally what it is. Employees, products, revenue. Good months, bad months, just like any company down the street. If you wouldn't buy the entire business, why buy a sliver of it blindly? Taking risks is fine, but know why you're taking them. Know what it's worth. Know your downside. Investing can feel boring sometimes, but boring builds wealth. Speculation just builds screenshots right before the crash. Here's a simple filter you can use today. Before buying any stock, ask yourself, could I explain in one sentence how this company actually makes money? If you can't, stop. You're not investing yet. You're guessing. Second question, would I still be comfortable owning this if the market closed for 5 years and I couldn't check the price at all? If the answer is no, that's a signal. You're leaning on price movement, not business quality. This isn't about avoiding all risk. It's about knowing the difference between a calculated bet and a hopeful guess. Real investors can explain their why. Speculators usually can't, past it's going up. Lesson 3. Margin of safety. This might be the smartest idea in the entire book, and barely anyone talks about it properly. Here's the rule. Never pay full price, especially not for stocks. No matter how good your research is, things go wrong. Economies shift, companies stumble, markets panic for no logical reason at all. You need a cushion. Think about building a bridge. If trucks crossing it weigh 10,000 pounds, do you build it to hold exactly 10,000? No, you build it for 30,000, just in case. That extra strength is your margin of safety. Same with stocks. Say a company is genuinely worth $50 a share. Do you buy at 50? Not even at 45. You wait for 30, maybe less. That gap protects you if you're wrong.
Look at 2008. Even blue-chip names like Goldman Sachs and General Electric were trading at fire sale prices, desperate for capital to survive the credit crisis. Not because they were suddenly bad businesses, because fear was running the show. That's exactly when Warren Buffett was buying, aggressively, $5 billion into Goldman Sachs, $3 billion more into GE. He wasn't guessing. He was buying value on a clearance rack. Here's a common question. What if you love a company, but the price keeps climbing higher? Simple answer, don't chase it. A great business at the wrong price is still a bad deal. Put it on your watch list, study it. Wait, Mr. Market will throw another tantrum eventually. He always does. Buffett once said the market moves money from the impatient to the patient. Your real edge isn't knowing what to buy, it's knowing when. So how do you actually build in a margin of safety? Start simple. Pick a number. Maybe you only buy when a stock is trading 20, even 30% below what you believe it's genuinely worth. That gap is your buffer, your protection against being wrong, because you will be wrong sometimes. Everyone is. You don't need a finance degree to estimate rough value. Look at earnings. Look at growth. Compare it to similar companies in the same industry. The goal isn't perfect precision. The goal is enough of a cushion that one mistake doesn't wipe you out. Patience is the real tool here. Waiting for the discount is doing something, even when it feels like doing nothing at all.
Lesson 4. Pick a lane. According to Graham, you're either a defensive investor or an enterprising one. There's no comfortable middle ground. Picture two people at the gym. One shows up, does a light jog, lifts a few weights, goes home. Just wants to stay healthy. That's the defensive investor. The other has a coach, a meal plan, a tracked routine. They're chasing serious results. That's the enterprising investor. Both approaches work as long as you actually know which one you are. If you're defensive, you don't chase hot stocks. You don't watch financial news like it's a thriller. You buy broad index funds. You invest the same amount every month, rain or shine. That's dollar cost averaging. Once a year, you check in, rebalance if needed. Then you let time and compounding do the heavy lifting.
If you're wired differently, if digging into balance sheets actually excites you, hunting for undervalued companies like a financial detective, then go enterprising. That's what young Buffett did. But understand something, it's real work, consistent, serious work, and it's genuinely not for most people. Graham was blunt about this. If you don't have the time, the skill, or the real interest to research properly, stay defensive. Nothing wrong with that. If you're obsessed and willing to outwork almost everyone else, go enterprising. Just don't float in the middle. That's the danger zone. That's where people end up chasing trends, buying high, selling low, and losing both money and confidence at the same time.
Not sure which lane you're actually in? Here's a quick gut check.
Do you enjoy reading a company's earnings report? Genuinely enjoy it, not just tolerate it. If yes, enterprising might fit you. If the idea of reading a 10K sounds like homework you'd avoid forever, that's your answer too. Go defensive. And that's not a downgrade. Most of the world's wealthiest long-term investors are quietly defensive, boring index funds, consistent contributions, decades of patience. Graham never ranked one lane above the other. He just insisted you pick one and commit. Half defensive, half enterprising usually just means full-time anxious. That's the one lane nobody should choose.
Lesson 5. Emotional discipline. Here's the part most people don't want to hear. Your emotions are probably your biggest threat to building wealth. Graham said it plainly. The gap between successful investors and broke ones isn't intelligence, it's discipline. The market drops 5% and suddenly everyone's acting like the world is ending. People sell everything in a panic. Meanwhile, that same stock was up 40% last year. Or the opposite happens. Some stock rockets overnight. Everyone's posting screenshots. Suddenly you feel the itch to jump in too. That's greed talking. That's FOMO. History repeats this pattern constantly. The dot-com crash, 2008, 2020. Some people panic sold everything. Others stayed calm, kept buying good businesses, and ignored the noise completely.
Guess who came out ahead a year later? Almost every single time. It's not about predicting the future. Nobody can do that reliably. It's about staying steady while everyone else is losing their mind. Markets will rise, markets will fall, sometimes for reasons that make zero sense. Your job was never to control the market. Your job is to control yourself. How? Build a system. Dollar cost average, rebalance on schedule. Follow your own plan instead of your own panic. Think about a pilot flying through turbulence. They don't yank the controls because of a little shake. They trust the system. Do the same with your money.
Want a practical way to build discipline? Automate it. Set up automatic transfers into your investments every payday, before you even see the money, before you can talk yourself out of it. This removes the decision entirely. No willpower needed on your worst emotional day. Next, write down your plan on paper or in a notes app. What you're buying, why, how long you're holding. When panic hits, and it will, read that plan back to yourself before doing anything. 9 times out of 10, your past calm self was smarter than your present panicked self. Discipline isn't a personality trait. It's a system you build once so you don't have to rely on willpower later.
Let's tie this together. 1. Mr. Market is moody, not wise. Uses panic, ignore his hype. 2. Stop speculating. Treat every stock like real ownership in a real business. 3. Never pay full price. Build in a margin of safety, always. 4. Pick a lane, defensive or enterprising. Just don't drift in the middle. 5. Master your emotions, because discipline beats intelligence every single time. None of these 5 ideas work in isolation. They work as a system. Understand the business, buy with a cushion, ignore the mood swings. Know your lane, control yourself. Do that consistently and you're already ahead of almost everyone chasing hot tips online.
And honestly, this is just scratching the surface. The intelligent investor has stayed relevant for over 70 years for a reason. There's a lot more inside it than 5 takeaways. If you want a part 2 going even deeper into this book, drop a comment and let me know. If this helped you see investing differently, hit subscribe. Money and Market drops videos like this every week. See you in the next one.